Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris Rapeseed, Winnipeg Canola, and Malaysian palm oil.
Paris Rapeseed. Since the triple top at the end of last year and the start of this year, we saw prices generally head low until mid-March. On the way down, key levels with a long moving average, currently at 493 even, the gap left over by changeover, originally 490 to 509 and 3/4 and since filled in, and the fall ended with a hammer pattern mid-March with prices subsequently rising and forming a V bottom pattern. Now, I thought there was seemingly another more interesting pattern developing here. You see, the fairly flat run-in during February and drop and rise in March made the whole action, as I mentioned 8 weeks ago, look like a possible bullish diving board pattern. Unfortunately, the market had other ideas as prices rose up to meet the gold long moving average and was stopped dead there 6 weeks ago, and now again this week. Interestingly, this week the flatlining gold long moving average was reinforced by the declining mauve medium moving average, currently 492.5. This action raises a question as to whether the move since late February to date might be an ascending triangle pattern in build-up between the mid-March to date uptrend, currently at 464.25, I've not highlighted it yet, and roughly where the gold long moving average is topside. I'm going to leave that question open for now. There is further support below from the 50% Fibonacci line of the May 23 to January 25 move below at 467.25 and a 2013 high at 464.25. These others led me to draw a prospective late February to early April bearish Andrews pitchfork, since financed to a dark blue bearish shift pitchfork, which you can see on my daily chart. However, I am not sure about this pitchfork now. It was, as I said at the time, I'm not wedded to this pattern, and I am quite prepared to finesse this to a shallower bearish shift pitchfork or retire it completely, but for now it will do in showing the recent bearish angle of attack. End of quote. I will look to retire this bearish shift pitchfork if the ascending triangle pattern develops, and that would probably be sooner than later. Winnipeg Canola. Back in March, the market halted its decline by a combination of the lows at 567 even, 571.80 and 575, plus the neckline extension, which is currently at 550.80, the April to June 2023 reverse head and shoulders continuation pattern. I'd possibly also throw in the combination of September 24 low and pipe bottom at 553.5 and the October 2020 high at 552.80. We didn't reach all these, but the proximity and market actions on approach to these suggested a swift and immediate pullback up for prices. Now, please remember the idea of the neckline halting prices, as this idea will pop up again soon enough. The recovery higher, though dramatic, initially had some issues. For instance, there was no weekly key reversal up, or even a lesser outside week opportunity here, as seen in other markets. The reasoning I gave back then, and which still seems sound, was because of the previously mentioned 50% absolute Fibonacci line that sat overhead back then at 606.90 and is now well below, seeming to put off any initial attempts higher. However, as I said 6 weeks ago, and I quote, the action over the last 3 weeks, so that is now 9 weeks, 6 to 9 weeks ago, the action over the last 3 weeks does suggest the construction of at least hints at the possible construction of an ascending wedge pattern, possibly even an ascending triangle. End of quote. Well, that became true with prices shot up through the 50% absolute Fibonacci line 6 weeks ago, hesitating for a bit around the moving average congestion area, which was then around the 2021 low at 629.60 before moving higher. Now, to explain this move upwards, I spoke 5 weeks ago of the possibility here for a start of February to date bullish diving board pattern. However, I did add that the, and I quote, pattern here is very, very crude, with the run up during February looking very straightforward not looking very straightforward in my eyes. The plunge in early March looks good, but the recovery higher in later March looks indecisive at the start, though we've since become more determined. End of quote. However, prices chose back then to continue their journey higher, making significant moves up and over the February high, despite a ropey start. This is a better bullish diving board pattern seen here than anywhere else in the oilseeds and veg oils I cover. It nevertheless still ran into resistance at the February high at 682.20 and the earlier July 24 high at 685.30, but prices have motored on through. To give you some context of this move upwards, here is the data regarding diving board patterns. Nearly 9 out of 10 times the price rises as high as the bottom of the board. Now, this is not a good example of a diving board pattern, but it would regard that as being about the 2021 low at 629.60, which we have seen. A quarter of them rise up within the diving board itself, so between 629.60 and the June 2021 low at 655.90, which we have also seen. Just over 6 out of 10 times prices rise up through the diving board, so that's over 655.90, which we indeed have also seen. In truth, we started to run into some serious overhead resistances, specifically some resistance I mentioned 2 weeks ago, and I quote, "Some generated congestion roughly between 723.70 to 735.20, plus a recent ascending wedge lower trendline extension, currently at 722.70, end of quote. Now I'd add to this the highlighted in dark blue neckline extension, currently 733.30, of the old August to October 24 reverse head and shoulders continuation pattern. This one has been particularly good at capping the market, and the only reason I didn't mention it before is that I thought the 723.70 to 735.20 congestion area overhead would have been enough. This just leaves this week's gapping changeover lower. This will likely lead to a weekly key reversal down, however much you may regard, as I do, or disregard the gap. Bursa Malaysia crude palm oil. Prices have over the last 6 weeks broken down through some major structural supports. To start with, there is the neckline, currently at 45.11, of the September to November 23 reverse head and shoulders pattern, which supported the market during March. 5 weeks ago, prices gapped lower below it. Next, and this one I will also commented on many times previously, is the neckline extension, currently at currently at 45.12, of the September 2015 to November 2017 head and shoulders top. I had not been sure about this one in the past, but as it was an old one, a super old one that had before been way below the current market back in the day, well, similar to the earlier neckline, it started this year significantly supporting the market, so it was worth noting, though it also failed 5 weeks ago. The third pattern here is a now flatlining long moving average, currently at 43.90, that stopped the market's fall dead in mid-January and late March, but which failed 5 weeks ago. There was also other, newer, and in some cases closer to the market features that had helped hold up the price, but which have now given way. To start with, I'd look to the wide congestion area now overhead between 44.08 to 45.59. This now weighs down on the market. Next, there is the significant combination of the 38.2% Fibonacci line of the May 20 to March 23 move and the 50% Fibonacci line of the May 23 to December 24 move, both at 42.74, and the lesser Fibonacci line just below that at 42.39. On this I said 4 weeks ago, and I quote, "It seems that some significant bearish pressure is meeting some quite substantial bullish supports. Something has got to give. And for now it's looking like the downside might. If it does, then apart from the July 23 high at 41.89, we might not have anything of note below until the congestion starting at 40.26. Caution." End of quote. Well, 4 weeks ago we gapped lower and dropped down through the 40.26 zone, briefly trying to become an elastic move back up, trying to fill in the gap left behind, but failing to do so, and making another smaller gap lower 2 weeks ago, and down to and through the interesting dark blue neckline extension, currently at 38.87. That's a key level, remember that. Of the small late May till April 24 reverse head and shoulders bottom. As I said 3 weeks ago, and I quote, "This is one to watch on the downside. as it is the core of a large April to September congestion zone stretching from roughly 3750 up to 4100. End of quote. I also added 3 weeks ago, and I quote, "These actions have brought to my mind another new pattern that may be just about completing, which can be even now still be derailed. It's to look at the whole move down from the high back in early December 24 to date as a really big halfway hesitation pattern. To give an idea of the potential on the downside, we have a possible target X down at 3750, right on the far end of the congestion we sit within right now." End of quote. Well, last week we reached down and achieved target at X at 3750, even though overshot it a bit. But we've had since then a reactionary move back up, such that the dark blue neckline extension is now a key support, resistance, and congestion point all at the same time. All this has caused me to draw a new purple bear channel pattern, currently at 3530 to 3297, and resurrect an old pattern, a bright green early December 24 to late February 25 bearish Andrews pitchfork. This latter pattern we are outside, but the broken upper time, currently at 3666, had in the past shown the bearish angle of attack, with the market running along the top side of the upper time. As for the bear channel, we are still within it, if just, but I'm fully expecting these bearish patterns to be tested now, with prices invalidating them by simply moving sideways. Watch this space, and especially watch the dark blue neckline.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.